Breaking news that every homeowner over the age of 60 needs to hear right now. If you paid off your house, or if you are close to paying it off, and you are retired or approaching retirement, what we are about to share with you today could be the most important financial information you receive this entire year. We are not exaggerating. Thousands of retirees across the country are unknowingly walking into a financial trap that is quietly draining their savings, inflating their tax bills, threatening their social security benefits, and in some cases pushing them out of government assistance programs they desperately need. For decades, the conventional wisdom handed down from parents to children was simple. Pay off your house as fast as you can, own it outright, and you will be financially secure in retirement. That advice made sense in a different era, and in many ways, owning your home free and clear still provides peace of mind and stability. But here in 2026, the financial landscape for retirees has changed dramatically, and owning a paid-off home without understanding the hidden consequences can lead to a chain reaction of financial problems that most retirees never see coming until it is too late. When you own a home outright in retirement, your net worth looks significantly higher on paper, even if your monthly income is modest or even very low. Your property taxes, your eligibility for income-based assistance programs, and the way the IRS calculates certain retirement-related taxes. Property values across the United States have climbed sharply over the past several years, and local governments have been reassessing home values at an accelerated pace. What this means in plain language is that even though you paid off your mortgage and eliminated that monthly payment, your annual property tax bill may now be higher than what your mortgage payment used to be. In several states, including Texas, Florida, New Jersey, Illinois, and California, property tax increases on homes valued over a certain threshold have been particularly aggressive. We are talking about seniors who expected to live comfortably on Social Security and modest savings suddenly getting hit with property tax bills of $8,000, $10,000, $12,000 a year or more. Now, many states do offer what are called homestead exemptions or senior property tax relief programs, and we're going to get to those in a moment because there are very specific steps you need to take to access them. These programs are not automatic. You have to apply for them. You have to meet income and age requirements. And you have to apply by specific deadlines. Missing those deadlines can cost you thousands of dollars. Now, here is where things get even more complicated. And this is the part that truly blindsides retirees who have done everything right their whole lives. In 2026, the interaction between your home equity, your income, and your federal benefit eligibility has become a ticking time bomb for many seniors. Let us use a real-life example so this is crystal clear. Imagine a retired couple. We will call them Robert and Patricia. Robert is 72, Patricia is 69. Their home is fully paid off and currently valued at $400,000. Together they bring in about $38,000 a year between Social Security and a small pension. On the surface, they seem financially comfortable. But here is what is actually happening beneath the surface. Because of their home value and the way it interacts with their income on federal and state benefit calculations, they are being excluded from or having their benefits reduced in programs that could save them thousands of dollars every year. Robert was recently diagnosed with a chronic condition requiring regular medication, and the couple applied for the Medicare Extra Help program to reduce prescription costs. They were shocked when they received a letter saying they did not qualify. If you are finding this information valuable, and we know you are, please take a quick second right now to hit the like button and subscribe to this channel. We cover critical updates like this one every single week, focused entirely on protecting the financial security of seniors and retirees. New rules, IRS changes, Social Security updates, Medicare alerts. We break it all down in plain English so you always know where you stand. Subscribe now and hit the notification bell so you never miss an update that could affect your money or your benefits. Let us now talk about what the IRS has updated in 2026 that directly affects homeowners in retirement, because this is where things get very technical, very fast, and we want to make sure you understand this clearly. The IRS rules around the capital gains exclusion for home sales have been a cornerstone of retirement planning for decades. Under the long-standing rule, if you are single, you can exclude up to $250,000 of profit from the sale of your primary residence from capital gains taxes. If you are married filing jointly, that exclusion doubles to $500,000. Sounds generous, right? Here is the problem in 2026. Home values have appreciated so dramatically in many markets that a house purchased in the 1,980 seconds or 1,990 seconds for $80,000 or $100,000 is now worth $500,000, $600,000, or even more. That means the gain on the sale of the home, even after the exclusion, could be enormous. And that taxable gain does not just result in a capital gains tax bill, it also gets counted as income for that year, which can trigger a cascade of other consequences. It can push you into a higher Medicare premium bracket under what is called IRMAA, the income-related monthly adjustment amount. It can cause more of your Social Security benefits to become taxable. It can affect your eligibility for various income-based programs. Imagine you bought your home in 1,992 for $90,000. You have lived in it, loved it, raised your family in it, and now it is paid off and worth $580,000. You are 70 years old, your spouse has passed, and you decide to downsize. Perfectly reasonable. You sell the house, take your $250,000 single filer exclusion, and that still leaves you with $240,000 in taxable capital gains. Now your income for that year, between Social Security, that capital gain, and any other income, has ballooned. Your Medicare Part B and Part D premiums could spike by hundreds of dollars per month. More of your Social Security becomes subject to federal income tax. And if you were relying on any income-sensitive benefit programs, you may find yourself suddenly disqualified, even though this was a one-time event. There is also an important and often overlooked tax consideration called the stepped-up basis rule, and changes in how it is being applied and discussed in Washington have created significant anxiety among estate planners and retirees. Under current law, when you inherit a home, the cost basis of that home is stepped up to the fair market value at the time of inheritance. This can significantly reduce or even eliminate capital gains taxes when the inherited home is later sold. However, there have been ongoing legislative proposals, some of which have resurfaced in 2026 budget discussions, that would modify or limit this benefit. While no final law has been enacted changing the stepped-up basis as of this script, the ongoing uncertainty means that if you are planning to pass your home on to your children or grandchildren, you need to be talking to a tax professional right now about how current rules apply to your specific situation and how proposed changes could affect your family's plans. The property tax exemption and deferral programs that many states offer, but that millions of eligible seniors are simply not using. Most states have programs specifically designed to help seniors manage property tax burdens, but the rules, income limits, age requirements and deadlines vary enormously from state to state and even from county to county. In many states, you must apply by a specific date each year, often in the spring, or you forfeit the benefit for that entire year. Income limits are typically set at levels that genuinely help middle-income seniors, often ranging from $30,000 to $75,000 depending on the state. Some programs reduce your tax bill outright. Others actually allow you to defer your property taxes until the home is sold, meaning you continue living in your home without paying property taxes, and the deferred amount is repaid from the proceeds when the home eventually sells. This can be a lifeline for a cash-poor but asset-rich retiree. If you have not looked into what your state and county offer, you need to do that this week. Call your local county assessor's office, visit your state's Department of Revenue website, or ask a local senior services organisation to help you navigate it. Tapping home equity through a reverse mortgage or home equity line of credit without fully understanding the tax and benefit implications. Reverse mortgages, when used correctly and for the right reasons, can be a legitimate financial tool. But they are not without risks and they are not right for everyone. The loan proceeds from a reverse mortgage are generally not considered taxable income, which is good news. However, the interest that accrues on the loan is not deductible until the loan is paid off, which often does not happen until the home is sold or the homeowner passes away. And while a reverse mortgage does not directly affect Social Security or Medicare, it can affect Medicaid eligibility if the loan proceeds are not spent within the month they are received and instead accumulate in a bank account. This is a subtle and dangerous trap that catches people who take out a reverse mortgage to supplement their income, but then do not spend the money quickly enough inadvertently building up assets that push them over Medicaid eligibility thresholds. If you are considering a reverse mortgage, or if you already have one, please speak with a HUD-approved housing counsellor and a tax professional who specialises in senior finances before making any major decisions. The emotional and psychological pressure that can lead retirees to make rushed financial decisions about their homes. We see this pattern repeatedly. A retiree loses a spouse. The house feels too big and too expensive to maintain. Adult children are encouraging a move. The property tax bill just arrived and it feels overwhelming. And so the house gets sold quickly, without proper planning, without a tax strategy, and without a full understanding of the financial consequences. The grief, the loneliness, the pressure. It all creates a perfect storm for financial mistakes. We are not saying you should never sell your home. We are saying that if you are facing this kind of crossroads, you owe it to yourself to slow down, take a breath, and get proper guidance before you act. A decision that cost you $30,000, $40,000, or $50,000 in avoidable taxes because of poor timing or poor planning is a tragedy that proper information could have prevented. First, if you own your home and you are retired or close to retirement, find out what your home is currently worth and calculate your potential taxable gain if you were to sell it. Subtract the applicable exclusion amount and understand what your tax exposure looks like. Second, call your county assessor's office or visit their website and ask specifically about senior property tax exemption, freeze, or deferral programs available in your area. Ask what the income limits are, what documentation you need, and what the application deadline is. Do not assume you do not qualify before you ask. Third, if you think you may sell your home in the next few years, sit down with a CPA or tax advisor who has experience with retirees and ask them specifically about strategies to manage the tax impact. Things like installment sales, charitable remainder trusts, or timing the sale to minimize IRMAA exposure. Fourth, if you have children who may inherit your home, talk to an estate planning attorney now about how the current stepped-up basis rules apply and how to structure your estate to maximize the benefits for your heirs. And fifth, if you are worried about making ends meet while staying in your home, explore all the relief programs available to you. Property tax deferral, reverse mortgages, senior assistance programs. Owning your home free and clear is still one of the greatest financial achievements a person can reach. It represents decades of sacrifice, hard work, and discipline. But in 2026, that achievement comes with a new set of rules, risks, and responsibilities that simply did not exist a generation ago. The tax code is more complex. Property values are higher. Benefit eligibility rules are stricter, and the financial consequences of making uninformed decisions about your home in retirement are more severe than ever. You earned this home. You deserve to keep it or sell it on your own terms, with your financial security intact. If this video opened your eyes to something you did not fully understand before, and we believe it did, please subscribe to this channel right now. Every week we bring you updates just like this one. Clear, honest, practical information about the rules, changes, and decisions that affect your money, your benefits, and your retirement. You worked too hard and too long to lose what you have built because of something you did not know. Stay informed, stay protected, and we will see you in the next video.